A lot of stocks cost an arm and a leg just to buy a single share. Luckily, there are still good stocks out there for investors on a budget. Hold on to your seatbelts, folks. This is going to be a good one. In the stock market, many prominent companies trade at high share prices, often putting them out of reach for investors looking to maintain a modest investment budget. Many companies can absolutely be quite expensive, requiring substantial funds to purchase even a single share. This high cost can be a barrier for frugal investors who wish to diversify their portfolios without allocating large sums to individual stocks. In fact, for this video, we're going to stick with stocks less than $15. By targeting stocks under $15, you can acquire more shares with the same amount of capital, enabling greater diversification. This approach not only makes investing more accessible, but also allows for a more balanced portfolio that can mitigate risk. I did find 5 great stocks. But before we get to today's list, I should mention that there is another way to make most stocks affordable, and that is by using WealthSimple. They allow for fractional buying of a huge selection of the top stocks. Instead of paying $86.51 for a single share of TD Bank, you can buy a fraction for a fraction of that price. So you could buy a half share for half the price, or maybe a quarter share for a quarter of the price. All reasonable fractions are accepted. If you are not yet on WealthSimple, no worries. There is a handy dandy referral link below that will give you $25 for setting up your account. And of course, full disclosure, it does give the channel $25 as well. Speaking of supporting the channel, the best way to do that is by hitting that sub button. For today's list, the big qualifier was, of course, that every stock had to be less than $15. I also wanted them to be more than $5 to keep those penny stocks at bay. We were also looking for a positive total return on their 1 year, which is also our sorting criteria for the list. In addition to all of that, they needed a positive return on equity, as we're really not interested in unprofitable stocks. So without any further ado, let's do this. Kicking off this list, we have Automotive's Properties REIT with a ticker of APRU. They are based out of Toronto, and they focus on owning and acquiring income-producing automotive dealership properties across Canada. Their current price at the time of recording is $12.18. They have a market cap of $597.48 million. Their beta a little bit less volatile than the market average at 0.92. Their earnings per share come in at 1.52, and they have a PE ratio of 8.01. Their return on equity, that's coming in at 11.73, and their return on assets, 3.78. Their debt to equity ratio, 78.62%. Switching to their dividends, they have the lowest yield on today's list, coming in at 6.60%. It is a monthly dividend of 6.7 cents per share. Payout ratio on that, 53.01%. So it's definitely sustainable. Looking at their returns, their 3-year return on investment, it does come in the negative 8.14%. Needless to say, REITs had a hard time through the bear market and the aggressive rate hikes. So that's actually not that bad for a REIT. Their total return after we add in the dividends, it does save them. It gets them up to 10.05%. So that's not too shabby. Looking at their 1 year, that return on investment, 14.04%, total return, 21.57%. It goes without question that this is a stock that is benefiting from those rate cuts, and they are expected to do well in the rate cut season for sure. Coming in at number 4, we have, once again, community favorite Canoe EIT Income Fund with a ticker of EIT.UN. They are based out of Calgary, and they are a diversified, closed-end investment fund that invests heavily in energy, financials, and healthcare. At the time of recording, their price was coming in at $14.79. They have a market cap of $2.63 billion, and their beta is just a little more volatile than the market average at 1.16. Those earnings per share coming in at 0.74, and they have a PE ratio of 19.99. Their return on equity, 17.10, and that return on assets, 9.90%. Debt to equity ratio is not bad, 10.74%. Looking at their dividend, They do have a yield of 8.114%. That's a monthly dividend of 10 cents per share. The payout ratio on that is coming in at 30%. Switching to returns, their 3-year return on investment comes in at 14.74%. Add in the dividends, we get a total return of 42.67%. That's looking pretty good if you ask me. On their 1 year, that return on investment comes in at 19.85%. Add in the dividends, we get a total return of 29.58%. I have loved this fund for a long time. One of the things I really respect about them is their management team and how they are, well, they're very good at rebalancing to ensure consistency even in the bad markets. Looking at their data, you can easily see that they did weather that bear market as well as the aggressive rate hikes pretty darn good. Taking our third spot, we have Timber Creek Financial with a ticker of TF. They are based out of Toronto, and they are a mortgage investment company that focuses on generating consistent income through a diverse portfolio of high-quality mortgage investments, primarily in commercial and multi-residential real estate sectors. Their current price comes in at $8.16, and they have a market cap of $667.36 million. Their beta comes in at 1.23, making them a little more volatile than the market average. Their earnings per share sitting at 0.73, and they have a price-to-earnings ratio of 11.18. That return on equity coming in at 8.73%, return on assets coming in at 3.50%. Their debt to equity ratio is a little higher than I like, 132.31%. However, they deal in mortgages. So you know right away they are going to carry a larger debt to equity ratio than most companies would. I give them a pass on that one. When it comes to their dividends, they have a yield of 8.456%. It's a monthly dividend of 5.8 cents per share. Payout ratio on that, 94.52%. Switching to returns, on their 3-year, the return on investment comes in at negative 16.82%. Factor in the dividends, we get back in the positive with 4.46% total return. This is a company that very much moves like a REIT, and thus they also suffered pretty hard through the bear market as well as those aggressive rate hikes. But they are now on the rebound, and you can see that when we look at their 1 year. So that 1 year return on investment, 21.97%. Add in the dividends, total return, 32.38%. This here is another stock that I have been a huge fan of for some time. Their strategy of really honing in on secured low-risk commercial mortgages has been a little bit of a beacon of consistent lower volatility returns. In our almost top spot at number 2, we have PHX Energy Services with a ticker of PHX. They are based out of Calgary, and they are an oil field services company that provides horizontal and directional drilling technology and, of course, services to oil and natural gas companies in Canada, the US, as well as internationally. At the time of recording, their current price comes in at $9.64. They have a market cap of $448.58 million. Their beta, quite volatile, 2.32, meaning that they're more than twice as volatile as the market average. Their earnings per share come in at 1.83, and they have a price to earnings ratio of 5.27. Their return on equity, really nice looking, 42.04%. Their return on assets, 10.65%. Their debt to equity ratio, pretty low, 20.51%. They have a dividend yield of 8.299%. It's a quarterly dividend of 20 cents per share. The payout ratio on that is 40.98%. So definitely their dividend is quite sustainable. Looking at their returns, on their 3-year return on investment, that comes in at 79.52%. Factor in the dividends, we get a total return of 111.17%. Holy banana bread, that's really good. On their 1 year, that return on investment comes in at 25.52%. Add in the dividends, total return 35.94%. The services this company provides is in high demand, as their advanced drilling technologies not only improves efficiency, but it saves on some of the high drilling costs. In our top spot at number 1, we have Fiera Capital with a ticker of FSZ. They are based out of Montreal, and they are an independent asset management firm that offers a wide range of investment solutions to institutional, retail, and private wealth clients. Their current price at time of recording comes in at $8.57. They have a market cap of $918.40 million. Their beta comes in at 1.64%, making them quite a bit more volatile than the market average. Their earnings per share, 0.54, and they have a price to earnings ratio of 15.87. Their return on equity coming in at 22.95%. And that return on assets, 7.03%. Their debt to equity ratio, now this one has the most debt out of everyone today, 259.56%. Once again, we are in the financial sector, and you will find debt to equity ratios much higher in this sector. I do think it's still a little bit on the high side, but it's not quite as concerning as you might expect at first glance. Looking at their dividend, they have a yield of, and this is the largest on the list today, 10.035%. It's a quarterly dividend of 21.5 cents per share. Now, their payout ratio comes in at 144.4%. Normally, I would say that's not sustainable. But if we look, and we looked at this before, if you look at a cash flow payout ratio, it's actually much better. That's coming in at 57.5%. So they do have the cash flow to sustain this. So that's something just to keep in mind. Looking at their returns, on their 3-year return on investment, that comes in at negative 19.53%. Factor in the dividends, we get a total return of 4.69%. So they did suffer through the bear market for sure. Looking at their 1 year, this is a much better story. Their return on investment comes in at 52.49%. Factor in the dividends, we get a total return of 67.79%. Yeah, that's not too shabby at all. This is a great company to gain some asset management exposure. Their diversified asset management offerings position it to benefit from growing institutional and retail investment demand, which should benefit, of course, from rate cuts as well. These are some pretty darn good stocks, and I do currently hold 2 of them in the 0 to 100K TFSA challenge. And there is at least one more I may be looking to add. I'll let you guys guess as to which one that may be. If you are interested in any of the stocks we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this deep dive on TELUS, and I will see you in the next video.